Hello everyone. In this chapter, chapter 12, we're going to specifically talk about the income statement. So we've had plenty of chapters dealing with the accounting cycle and then talking about specifically all of the items on the balance sheet. We talked about cash, receivables, inventory, fixed assets, intangible assets. Over there on the liability side, we talked about all the liabilities. And then we had a full chapter on equity. Well, we worked our way through the balance sheet, and now in this chapter we're going to talk about the income statement, which is basically the statement for the period of, basically for the year, beginning and an end period, and it summarizes all of the revenues and gains, less the expenses and the losses. So basically what we're going to do here is we're going to first show you what an income statement looks like. So you can see it starts out with net sales, which is basically the sales less the contra sales accounts, the sales returns, the sales discount accounts that we talked about earlier. And then we have our cost of goods sold. We have our selling, general, administrative expenses, and possibly another gains and losses. Here we see we have a loss on a settlement of a lawsuit, and we get a subtotal, income before income taxes, and that gets us, and then we subtract out our income tax expense, and then we have another subtotal called income from continuing operations. And then we take into consideration any discontinued operations. And you can see underneath discontinued operations we have two items. We have the operating loss on the discontinued operation and the gain on the sale of the discontinued operation. So let's talk about that, discontinued operations. From time to time, management, if there's a large corporation, management's going to decide to dissolve one division or maybe sell it off. And when they do so, they enter into a formal plan to sell or discontinue a segment of the business. Let's just take as an example Honda. What does Honda make? Well, they make automobiles, they make lawnmowers, right, and all the lawn equipment. They make motorcycles, off the top of my head. Now, let's say one day they decided, you know what, we're not going to make motorcycles anymore. Well, that would be an example of a discontinued operation. Now, what you have to know is you can come into this plan, Honda can come into this plan to discontinue selling motorcycles, but that may take 4 or 5 years to either sell it off or completely wind it down, to discontinue it. So there is a time period. My point is this: there is a time period between the plan to discontinue and when the actual discontinuance or the selling of the division takes place. Therefore, over that time period, we're still going to operate the business. So we will, once we note that something is a discontinued operation, it's going to be shown in a separate section of the income statement, like you see here, down here. And the operating gain or loss on that sale, net of taxes, are going to be shown here. And then, of course, if we sell the division, the gain or loss on the sale of the division will be separately stated. This, obviously, the gain or loss on the sale of the division will only happen once in the year that it's actually sold. But while it was declared discontinued, up to that point, it could be many years, we're going to have this operating gain or loss that we need to account for separately from continued operations. And that's basically what this slide is saying. Now, the two items that we will disclose in the income statement for discontinued operations is the income or loss from operating the segment prior to its disposal, which could take many years, and the gain or loss on the actual disposal. Now, one thing you have to know is these are going to be shown net of tax. We're not going to show the gain or loss and the tax expense underneath it. It's actually going to be disclosed net of tax. Okay, another item that you might see on the income statement, in addition to continuing operations and discontinued operations, are these items called unusual and/or infrequent gains and losses. Unusual and/or infrequent gains and losses, they don't recur all the time. They're not predictable. Sometimes they're referred to as non-recurring items or one-time items. Sometimes you'll hear in the business news there was a one-time charge for this particular company when they reported earnings. Well, that's what we're talking about here. So you can see some examples: labor strike losses, gain or loss on a sale of a plant, storm, natural disaster, losses due to lawsuits. We hope these don't occur all of the time, and we hope they're not in a predictable pattern. So that is something that would be separately stated. Unusual and or infrequent items are not presented on a net of tax basis. Any income tax effect is combined with the income tax on the normal recurring revenue. So just wanted you to see that. Restructuring charges is something that happens from time to time if a company goes through a restructuring. Maybe they just, there's a whole bunch of terminated workers because of your restructuring, and there's a massive layoff. Maybe you have to relocate operations. These are examples of restructuring the business, and that would be another example of something that would be disclosed separately. We don't want to lump that in with the continuing operations. Bottom line, we want to make sure that we give the readers of the financial statements enough information to understand that what is recurring operations, what is non-recurring, what is discontinuing, etc., etc. Okay, now some ratios that are pretty important to the financial statements. The first is called earnings per share, commonly known as EPS. I'm sure a lot of you, if you read or listen to the business news, you have heard about this calculation. The EPS, basically, we have a calculation. The numerator is the common stockholder's share of the company's net income, and the denominator is the average number of common shares outstanding. As you see from here, common stock is the most important calculation, or is the stock that's taken into consideration, is what I should say, when we try to calculate earnings per share. Preferred stockholders have no claim to earnings beyond the preferred stock dividend, so we do not want to calculate earnings per share for preferred shareholders. All right, let's take a calculation so we can see how this works. Assume a company has 80,000 shares of common stock outstanding during the first 9 months of the year. And starting in month 10, if we're dealing with a calendar year, that would be October, the company then sells an additional 60,000 shares. And so from October 1 to the end of the year, 140,000 shares were outstanding. So what we want to do is we want to calculate a weighted average. So as an example, 80,000 shares were outstanding for 9/12 of the year. If you do a little mathematical calculation, 80,000 times 9/12, you'll get $60,000. And then 140,000 shares were outstanding for 3/12 of the year, the last 3 months of the year. So the weighted average, even though some of the year, or the majority of the year, 80,000 were outstanding, the last 3 months of the year, 140,000 shares were outstanding. The weighted average per our calculation is $95,000. If net income for the year was $250,000, then we're going to take 250,000 divided by 95,000, and so we'll calculate our earnings per share. In this case, $2.63. In the business news on Wall Street, this EPS is constantly analyzed. The EPS actual versus what was expected, the EPS last quarter versus this quarter, last year versus this year. There's a lot of analysts that utilize this number, this calculation, in regards to deciding whether this company should be, the stock should be bought or not. So this is a good calculation, earnings per share. When a company has preferred stock outstanding, what we need to do is we need to take out the preferred stockholders' dividend from net income. Remember, the numerator is net income that is applicable to common stockholders. So our numerator might only be net income if there's no preferred stock, but it also might be net income minus the preferred stock's dividend if we have preferred shares. Only the current year's dividend is going to be used in calculating earnings per share, even if dividends are in arrears. So that's something that you need to understand. Let's take a look at an example. Assume Perry Corporation has 200,000 shares of common stock and 12,000 shares of $6 cumulative preferred stock outstanding throughout the year. Net income is $595,000. Let's compute the earnings per share. Well, the numerator, we're going to start with the $595,000, but we need to subtract out the preferred dividends for that year, which will have to be 12,000 shares times $6, or 72,000. Subtract that from the net income. So the earnings applicable to the common shareholders is not the full net income of $595,000, but the $523,000. Divided by your weighted average number of shares outstanding, and that was 200,000. So your earnings per share in this example is $2.62. Earnings per share are required to be disclosed, and if an income statement has different sections, if we have discontinued operations, etc., we want to show earnings per share for all of the sections on the balance sheet. Okay, you can see here's an example of a real-life financial statement. The company is disclosing earnings per share for continuing operations, for discontinued operations, and overall net income. Now let's turn our attention to dividends. Dividends are a distribution to the shareholders. A lot of investors buy stock with the expectation of getting a dividend. There are many types of dividends, actually two main types: cash dividends and stock dividends. There are also something called the stock split, which I showed you in the prior chapter. Now, let's talk about cash dividends first. Cash dividends is a payout of the retained earnings, bottom line. And that's ultimately what retained earnings is. Retained earnings is the revenue less the expenses, i.e. the net income for the year, less dividends, and its cumulative effect over time. So if the company is 50 years old, the retained earnings will be the net incomes less the dividends cumulative for the past 50 years. Okay. Why would a company give a cash dividend? Obviously a reward to the shareholders. If there's a lot of cash laying around that we don't need for future operations or future expansion, a dividend could be declared by the board of directors. And that is the first step in recording a cash dividend. There needs to be the board declaration of the dividend. That is a formal action. When that occurs, that is called the date of declaration. That is the day that we actually make a journal entry to record the dividend. It may not be paid out on the date of declaration, but it's recorded on the date of declaration. The next important date is called the ex-dividend rate. This is the date that if a person owns that stock on that date and going forward, they're going to get the dividend. So you want to make sure that you own that dividend on that date. And then, of course, we have the date of payment. The date of payment is when the dividend is paid out. Okay. So let's take an example, accounting example. December 15th, the board of directors declares a $1 per share cash dividend, and we have 125,000 common shares outstanding. The dividend is payable to stockholders of record on January 10th and paid on January 25th. So on December 15th, when the dividend is declared, we are going to record this journal entry. We're going to debit dividends. And remember, dividends is a contra retained earnings account. It reduces retained earnings ultimately. And we're going to debit that, and we're going to credit dividends payable. which is a liability. Now, January 7th, this is the ex-dividend date, the day which serves as the ownership cutoff point for receipt of the dividend. And then, of course, the date of record. And then, of course, and those dates, there are no journal entries. And lastly, we have the date of payment. So we only have 2 journal entries, on the date of record and also the date of payment. The date of payment, we're going to record the payment of the liability. So we can see, in this case, January 25th, we're going to debit the liability, dividends payable, and we're going to credit cash. So that's the important dates when we're talking about dividends. The date of record, and of course, the date of declaration, and then the date of payment. Those are the dates that we are going to record journal entries. The second type of dividend is actually called a stock dividend. And with a stock dividend, we actually don't give out a cash reward, but we give out additional shares of stock. This is common when a company is brand new, there's not a lot of cash flow, but they still want to reward the shareholders. And so we would reward them with additional shares of stock. And if this is a company that the stockholder believes in, is confident in the future growth potential of this company, this is going to be a nice reward. All right, so a stock dividend, there is no cash changing hands, and a stock dividend will simply be changing the components of equity. We don't change overall stockholders' equity, but we do indeed show that or record the components of equity are different. So let's take a look at this. Here's an example. Assume a corporation with 2,000 shares of common stock outstanding is owned equally by 2 shareholders, 1,000 each. The company declares a stock dividend of 10%. So if there are 2,000 shares outstanding, you take times 10%, that gives you 200. That means 200 shares of stock are going to be distributed in this stock dividend. Now, how do we record stock dividends? There are 2 types of stock dividends. We have a small stock dividend and we have a large stock dividend. A small stock dividend is typically when we issue less than 25% of outstanding shares. And that's what we have here. We issued 10% in this example. And greater than 25%, that would be considered a large stock dividend. That's a big difference because a small stock dividend is actually accounted for using the current market value. A large stock dividend is accounted for using the par value of the stock. In this case, it's a small stock dividend. So let's take a look at this example. Assume that on June 1, Aspen Corporation has 100,000 shares of $5 par value common stock, and the market value on the date is $25 per share. On this date, the company declares a 10% stock dividend. Once again, anything under 25% is considered a small stock dividend, and this would be the typical stock dividend, would be small. And it's going to be valued at market value. So what is the market value on this date? It's $25. So 10% of 100,000, that's 10,000 shares. 10,000 times $25, that means the entire stock dividend is valued at $250,000. And if you take a look at this journal entry, we're going to debit retained earnings for that $250,000. Now, what are the credits? Well, if we actually distributed the stock, we would credit common stock for the number of shares issued times par value. If we did not distribute the stock on the date of declaration, which of course is common, we don't actually distribute and declare on the same day, we're going to credit this account called stock dividend to be distributed. This is an equity account, just like the common stock account, and this is going to be valued at just like the stock account, the number of shares issued times par value. The number of shares issued in this case is 10,000 times par value of 5. That's where you get your 50,000. Anything above and beyond, we will credit to additional paid-in capital. Okay, and then lastly, when we actually distribute the stock, I don't have a I don't have a slide to show you that, but when we do distribute the stock, we debit this account, stock dividend to be distributed, and we credit the actual common stock account. So it's just a timing difference. Okay. All right. We saw stock splits in the prior chapter, and I just showed you stock dividends. Well, with stock dividends, whether they're a small stock dividend or a large stock dividend, total equity doesn't change, but you can see the components of equity changes. With a small stock dividend, as you saw a few slides ago, it changes common stock, it changes additional paid-in capital, it changes retained earnings, it decreases retained earnings, but it increases common stock and paid-in capital. Large stock dividend, although I did not show you an example of it, I did tell you that it is valued at par value, so it just changes retained earnings and common stock. Stock splits have no effect at all on any of the equity accounts. There's no journal entry for stock splits. The only thing we do is we change the par value and the number of shares outstanding. So there is a difference between stock dividends and stock splits, accounting-wise. For the investor, it's pretty much the same, right? Because with a stock split, you're getting extra shares. With a stock dividend, you're getting extra shares. How they behave with market values after a stock split or stock dividend, most likely it would be behave differently with a stock split. Typically, the market value is going to get cut. With a dividend, a stock dividend, most likely the market value is not going to have much of an effect. All right, so in addition to the income statement, I wanted to show you what a statement of retained earnings would look like. And once again, a statement of retained earnings, and I showed this to you very elementary anyway, earlier in the semester. It's a roll forward of the retained earnings account from the beginning of the year to the end of the year. So here's an example. Retained earnings at the beginning of the year, and you can see in this example it was $750,000. Retained earnings is going to increase with net income, so we will say add net income for the year. Then we get a subtotal, and then it's going to go down by dividends. In this particular example, we have cash dividends, and we also gave out a stock dividend. All dividends reduce the retained earnings, and so we get to the retained earnings at the end of the year. Okay, I have to admit accountants are not perfect. And because accountants are human and they're not perfect, they sometimes make mistakes. Sometimes you don't remember that mistake or you don't realize that mistake until the period is over and we moved on to the next period. Well, how do we fix that? We're going to fix that by recording what's known as a prior period adjustment. So a company's they may discover in a future year a material error, not an immaterial. I'm not talking about a few dollars here. I'm talking about a material error, something that would possibly make a difference in a decision maker's mind if it wasn't brought to their attention. That's kind of the definition of materiality. All right, well, a prior period adjustment, basically what we're going to do is we're not going to go back and change the prior period financial statements, but what we will do is we will record an adjustment to retained earnings. All right, the correction is known as a prior period adjustment. A prior period adjustment may increase or decrease retained earnings. All right, so that's something that we want to record. Here's an example. Assume that in 2018, Salt Lake Corporation discovers that it failed to record depreciation on certain fixed assets last year in 2017. After considering the income tax effects of the error, the company finds that the net income reported in 2017 was overstated by $35,000. Well, the beginning balance of retained earnings was $750,000, but we figured out that that was overstated by $35,000. So what do? Well, we're going to record a journal entry for this prior period adjustment, and you can see after we record a journal entry for a prior period adjustment, this is how it would look. You can see the retained earnings. What we're going to do is we're going to say as originally reported. we want to make sure that there's a link from the prior financial statements to the current financial statement. So we got to keep the 750, but we're going to put in here less prior period adjustment for the error. All right, and so that's what this $35,000 is. In the example that we're talking about, missed depreciation, obviously the other side of the journal entry would be a credit to the accumulated depreciation account. And so then we have our restated retained earnings, and then we go from there. So we definitely want to show in the year of the prior period adjustment, the originally reported beginning retained earnings plus or minus the prior period adjustment. Okay, and the last topic here in this chapter deals with comprehensive income. Comprehensive income is a term that identifies the total of net income plus or minus other income items. An example would be like when we hold investments for a long time and we don't have the intention of selling it right away. We actually want to hold on to it for a while. Well, those unrealized gains and losses as we're holding the investments, you guys know you might have an investment portfolio, maybe a 401k plan. You know your 401k balance goes up and down, up and down. Well, those ups and downs, they're called unrealized gains and losses. They're not realized because you didn't sell anything out of your 401k, but as you're holding it, this is the holding gain or loss. Formally, the formal name is unrealized gain or loss. Well, the unrealized gain or loss for securities that we're holding for the long term, that would go through not the income statement, but something called comprehensive income. And typically, that is reported as part of the equity section. So that's something that you need to know as well. All right. Now, at the end of the day, we have the equity section of our balance sheet. You can see here, we have our preferred stock and our common stock. Look at all the required disclosures. As an example, for preferred stock, we're required to disclose the percentage rate for the dividend, and this is 5%. It's convertible. It's preferred, $100 par value, the number of shares issued or authorized, issued, and outstanding. In this case, 3,000 are authorized and issued. Common stock, the par value, number of shares authorized, number of shares issued, and outstanding would be the difference between what's issued and what's in the treasury. The additional paid in capital, we could see we have APIC from common stock as well as stock dividends. And then we have our retained earnings. And then, of course, we subtract out our treasury stock as we talked about in a prior chapter.